you buy an investment property without having to verify your personal income. No W-2s, no tax returns, just the income from the property itself. Sounds pretty wild, right? That's the beauty of a DSCR loan, and today I'm showing you exactly how they work. I'll also share when a bank statement loan might actually be a better option and how you can use AirDNA to qualify for short-term rentals. But with a few important warnings that a lot of lenders aren't going to tell you. Before we dive in, grab my free DSCR guide. It's linked in the description below. It breaks everything down with examples and pro tips that you can use today. What is a DSCR loan? DSCR stands for Debt Service Coverage Ratio. It's a loan designed for real estate investors that want to qualify based on the income the property itself produces and not their personal income. So instead of pay stubs and tax returns, the lender asks, does the rent cover the mortgage? If yes, you're most likely good to go. It's especially helpful for self-employed borrowers, full-time investors, and those that are looking to scale quickly. Here's some fast facts about the DSCR loan. No personal income documentation. It's for investment properties only, not primary residence. It's occupancy fraud. No DTI or debt to income requirements. They allow credit scores as low as 620. Fast, streamlined approvals. They're one of the few loans that allow LLC vesting, so you can hold the property in an entity. And you can use short-term rental to qualify in a lot of cases. Sounds awesome, right? Let's keep going. How is DSCR calculated? Here's a simple formula. DSCR equals gross rental income divided by your mortgage payment, PITI plus the HOA if there happens to be one. So if the property brings in $2,500 and your mortgage is $2,000, the DSCR in this case would be 1.25. Now most lenders are looking for a ratio of at least 1, but there's plenty that'll go down to 0.75, and there's even a few that'll do a no ratio DSCR loan. Now real talk, sometimes the DSCR loan isn't the best option. If the property has weak rental income, or it's your first deal and DSCR doesn't pencil out, a bank statement loan might be better, assuming you're self-employed. These loans qualify you as the borrower based on your business income, using your last 12 or 24 months of bank statements instead of tax returns. This can be a better fit or just give you better terms if the property isn't cash flowing yet, but you have solid income flowing through your bank. At Monarch Lender, we look at both options, the bank statement and the DSCR, to structure your loan to give you the best terms and what's going to give you the quickest path to closing. Now, if you're buying a short-term rental or Airbnb, you're going to love this. Some of our DSCR investors will qualify you based on AirDNA projected revenue, not bottom line. That's huge, especially if it's your first short-term rental or you don't have a full year of income to show. But here's the catch. A lot of banks will tell you that they'll qualify an AirDNA income, but they're still going to require a 1007 appraisal to back this up. The appraiser is not able to find similar short-term rental comps in the area, could totally derail your deal. Some lenders will say they allow short-term rental income, but then they're leaning on the 1007 and the appraiser, and that's where you can go down a real rabbit hole. Make sure your lender has short-term rental experience. We work with multiple investors that understand the space and know how to structure the deal. Now, if you're planning to use short-term rental income or just not sure which loan would be best for you, hit my Calendly link below. Let's hop on a call and we can work through it and figure it out together. All right, to qualify for a DSCR loan, you typically need credit score of 620 or higher, 15 to 20% down, a property in good rent-ready condition, no major fixers, and lastly, rent that's going to cover at least 75% of the mortgage. And remember, you can use short-term rental in some cases, which will juice up your ratio. All right, so let's look at how we come up with pricing for a DSCR loan. Better pricing depends on 4 key things. Number 1, the loan-to-value ratio, so a bigger down payment, going to give you better terms. Number 2, might seem obvious, but the DSCR score, the higher the ratio, the better the rate usually. Number 3, prepayment penalty. Accepting a prepayment penalty can get you a lower interest rate on DSCR loan, and usually the longer you go with your prepay penalty, the better the terms you're going to get. Number 4, credit score. These are done in 20-point brackets, so every 20 points you move up, you're going to get better terms. Even a small tweak on these inputs can save you thousands. That's where working with the right broker comes in. All right, here are the property types that are allowed. Single family, condos and townhomes, 2 to 4 unit properties, and commercial properties in some case, 5 units and above. All right, here are properties that aren't allowed. Primary homes. Don't try to get me in trouble here with reverse occupancy. Don't do it. Land or construction. And lastly, major fixer-uppers. Renovation loans, that's a whole different ball game. Talk about that in another video. If you're trying to grow your rental portfolio and want to skip the normal income documentation mess, DSCR loans are a powerful tool. But don't overlook the flexibility of a bank statement loan if you're self-employed. Depending on the deal, you might qualify for a better rate there. And if short-term rentals are your focus, we can use AirDNA income the right way and avoid some appraisal surprises. Download the free guide below and book a strategy call if you're ready to game plan your next deal.